Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show, and I want to go through our normal breakdown of the 5 shows, but we want to look at global trade and how that relates to capital movement, capital mobility, but at the same time, what is happening in the global rates market, because that's going to be a much bigger issue when you start looking at how growth is going to progress. Then we're going to look at another hike coming in the Fed. That's something that we've been talking about. We do think that continues to be the likely case. Then we want to look at how savings is rolling over and how leading economic indicators remain mixed. It's not a huge this is clearly a huge recessionary piece. This is a good growth piece. It's just there's still that mix back and forth, and we want to look at how the trends are really kind of shaping up. Then we want to look at European data, which continues to fall. I mean, the fact that the ECB can come out and say that the European area is going to avoid a recession is baffling to me. And then we want to look at how Chinese real estate. So for those that have been watching us, we've been saying that the Chinese real estate problems never went away. There was this view where it kind of fell out of the headlines and then it fell out of people's minds, and now here it is, coming back with vengeance. So with all that being said, we want to now get right into segment 1. And here you can see the millionaires and billionaires moving around. So the benefit for those that have high net worths, you can be mobile. Mobility is very easy at these different times, and the net worth of at least $1 million will move throughout. So 122,000 high net worth individuals have moved, and you get an idea of where they're going. And it's interesting because when you look at the shifts, it's not really a surprise when you look at China, when you look at other parts of Asia, when you look at India, they're all moving and getting into areas where they can protect their wealth, but also find opportunity. And, the UAE has been a very interesting dynamic when you look at the money that's being attracted in there. Singapore is the same thing, but a lot of that is China. When you look at where the Chinese millionaires, billionaires are going, a lot of them, given they're still coming to Canada and the US, but more and more of them are going into Singapore, Australia, and the UAE. Obviously, Switzerland and France, more Switzerland, you can protect capital. Greece is a friendly spot for Russians, same with the UAE. But the U.S. as well, and that's an interesting piece. When you look at a lot of the Russian wealth, a lot of that migrated not so much into Europe, but into Canada and into the U.S. because there is a certain amount of similarities when you start looking at kind of mindsets and the way things work. So this is something that's going to continue, and this is a bigger issue for China. India, some of that will slow. The Chinese movements are problematic because if you remember back in, I think it was 2013, when they really ironed out the Made in China 2025. The goal was to bring back people that had PhDs in advanced computers, advanced technology, all different types of AI type degrees, advanced degrees. But the biggest, and in order to do that, they wanted to clean up the environment. They wanted to provide IP protection. And a lot of that has weakened, not so much on the environmental side, but more on the IP side. And let's be fair, if you're a wealthy individual that either has some patents, has some IP, and a PhD in AI or advanced computing, those are transferable skills. And so that's going to be an important one to watch as you look at some of these different flows. And it's becoming more important as well when you start looking at where the wealth is traveling, because it's also a matter of, where is there the most opportunity? And when you start looking at the Bloomberg GlobalAgg index yields, you can see the global investment grade debt. Now, it should be clear that this is from the 21st of September, so it's actually only gotten worse from here. When you look at those rates going up, in the U.S., the 10 years now over 4.6%. And it's pulling a lot of things with it because, again, the U.S. 10-year is kind of the standard, or sets the standard that a lot of things are pushed against. So then the central banks are speeding up their balance sheet reductions. Something that is also progressing that we really have to pay attention to when you start looking at, the end of that QE and more of that QT. And by doing that, you're putting more debt into the market and you're pulling out that cash. And that's going to be a common theme that we want to look at as we go through not only just segment 1, but also segment 2, because this is going to pull out that liquidity, but create tightness in the banking markets, increase the demand for credit worthiness, and that's going to become a much bigger issue. Now, when you look at the number of recessions in the G7 since 1929 and then since 1982, it's interesting how you've seen some of these declines, but one of the things that we heard, it was funny, I think it was December of 19 or November of 19, when Yellen and several other high-profile individuals said that we've ended the business cycle and we'll never have another downturn. Now, the problem is all of the downturns before were papered over with just a significant QE. We went from providing a little support in 2008 to just going crazy with liquidity. Now, our point is that creates long-term problems. So yes, it was a short-term solution, but results in long-term issues. And we've seen that with rates, we've seen that with inflation. And realistically, inflation during all of this papering period was grossly undervalued or underweighted. And there was way more inflation in the world, especially in the US, versus what was actually reported. And now that, the disguise of what they were trying to do has been blown away. So even though the number of recessions has been smaller, we do see more problems coming up, especially when you kind of relate how things are happening in general. Then when you look at the foreign private sector holdings of sovereign debt, you can see that Europe has a lot of exposure, France, UK, Italy. But it's interesting, US, Germany, Canada, Japan are a bit on the lower side. The interesting piece is the US, and I want to touch on the US here because we're seeing more people looking at this saying, hey, I can get a CD, I can get a bond that pays over 5%. It's like, that's a pretty good deal, especially when you look at some of the risk in the markets, things that we've had a nice little run up following some of the sentiment that has shifted. Now you're really getting to a good point where you're like, well, 5.5% for 2 years seems like a good deal. Even the 10-year, as much as someone, excuse me, I have a cold or allergies or both at this point. I don't know. It all kind of bleeds together. One of the issues that we've continued to see is when you look at the market in general and you can say, okay, well, the 10-year at 4.6%, 4.7%, maybe this is pretty good. Maybe this is something that is a good opportunity. Now, could the 10-year continue to move higher? Yes. 5% is very doable. But now is a good time to increase some of that exposure and getting back a bit into that fixed income market. And one of the reasons why is when you look at some of these, and we use this chart again a little bit lower, but it's important to look at the implied Fed funds target rate. When you look at current level, the current level is, you're still seeing that there's one more hike coming. And again, this is very consistent with what we see or what we think is going to happen, which is another quarter point. Now, you could see in 2024 that shift continues to move up in terms of where the dots, if you will, are projecting. And we do think that that's going to continue to grind higher. But it's important to look at the dot profile in 2024. It's over 5%, and there's more and more of that expectations. And then the latest dot plot for the end of next year is 50 basis points higher than the June projection. And it's interesting because that's going to be continuous. We had another reacceleration of inflation in October. In September, we should slow down a little bit in October. It's still going to be month over month increases. And then the problem is the year over year is getting harder and harder. And I think that's a bigger issue in general when you start looking at some of the flows, looking at some of the different shifts. Now, when you start looking at food pricing, you can see that food prices on a real level, nominal level, have come back a bit. But it's important, going back to 1961, you get an idea of kind of where things are. When you look at it, this is the second highest it's ever been in relation to real numbers. I'm sorry, this is the second highest, because when you look in the 70s, we had something similar, and here we are. Here's a very interesting point in terms of where the food price index sits and the pressure that remains in that system. Then when you look at where the world food price year over year changes, it's still negative, but you can see it's curling back up. And this is what we were saying, is that things are going positive again because there's more pressure out there. We've seen India, we've seen Vietnam, we've seen Indonesia, we've seen Russia, we've seen a lot of different countries put up gates, either ban outright some of these exports. And that's going to be a problem over time when you look at pricing and when you look at those inflationary pushes. And it's not that we're going to see another massive increase in food prices. It's just they're going to stay elevated. They're going to stay higher. And the problem when you start looking at food yields, if you look in the 70s, that was when we had a fairly sizable shift in some farming practices. And you had some adjustments in terms of fertilizers that were being used. And you had a really nice bump in yields. Then you started to see GPS being used. You started to see farming practices get more efficient. Another bump in yield. The problem is now, after 40 to 60 years of, not to say improper, but overutilization of tools, is becoming a much bigger issue in general when you start looking at yields and why we focus so much on the problems that we see coming up. Global trade falls at the fastest pace since early the pandemic. The S&P Global Purchasing Manager Index tracking new export orders indicated a sharp contraction in August and September across the U.S., Eurozone, UK. Economists now expect the Eurozone export volumes to be flat on the year, after forecasting an expansion of 2%. And again, this is where we continue to see. And the global trade side continues to, again, move to the negative front. And when you look at it, you've seen a fairly steady drop in terms of volumes on both a value as well as, and more importantly, volume. And I think the volume is the biggest, because when you look at the dollar numbers look a little bit better because you have the inflation side. But when you look at just pure value, you're moving less stuff, and it might cost a bit more, but again, you're moving less stuff, which is a much bigger issue. Then now when we look at Russian diesel flows, Russia has banned diesel exports as the winter comes up, but this is important because when you look at diesel and you look at some of the problems that we've been highlighting, Russia has obviously a decent amount of refining, but they require catalysts, they require maintenance. And a lot of these pieces of equipment and chemicals come from the West, and they're not able to get them. Now, can they supplement some of this from both China and India? Yes. But it takes longer. They might not have the same availability. And let's be fair, the war effort consumes a lot of diesel, a lot of product. And that's becoming an issue. We had a friend of the show who is in Russia, and he was saying, he asked a couple weeks ago, he's like, Mark, we're seeing diesel prices go up, gasoline prices go up. What do you think happens? And this is one of these issues. You're seeing these problems reverberate. So the other issue is when Russia can no longer convert some of this crude into product, well, where are they going to put the oil? Because it's very difficult, and one of the things they've tried to avoid is shutting in wells, reducing activity. Because when you do that, when you reduce that activity, well, there's a likelihood they'll never come back online. So that's where we could see some increases in some of the crude flows that are being exported. Now, when we start looking at some of the different indexes, when you look at the HARPEX index, you can see that there is a reduction in shipping cost. So you can see it started to go up. And as we've been saying, and as we've been predicting, that movement up was more timing. Some people were taking advantage of cheaper pricing. You do need inventory. You need to have stuff on the shelves. And now you're starting to see that slow down. But the bank lending to the private sector and emerging markets, mature markets are all coming down. And this is what we've been talking about with when you look at rates, when you look at borrowing, when you look at trade and global activity. As rates go up and lending typically lending goes down. And that's something that we don't see pivoting anytime soon. If anything, we see it actually contracting further, which again is going to put pressure on that global growth. Now, this is just kind of rounding that out. The level of World Trade Volume Index has fallen to the lowest since October of 2021. Index has fallen by more than 4% year on year, which is consistent with prior recessions. And again, this is very much in line with what we've been saying, the problems that we've been highlighting in terms of demand, and why as we see pricing going up, as we see that pressure going up, that's where we'll see economic activity fall and more pressure come into the system. So that's what we have here on the global front, global trade side. The next segment, we're going to go deeper into the US and some of the issues that we see at the Fed and at the rates level.